If you're trying to figure out how to invest your money in 2025, you've probably done some homework and you've probably heard the terms like ETFs, index funds, mutual funds, or individual stocks. But what do these actually mean? And more importantly, which one makes the most sense for your goals? So today I'm going to break down what all four of these types of investments are and help you understand how they could fit into your financial picture. We're going to go over the pros and cons of each and which one might be right for you. So whether you're brand new to investing or you're just looking to refine your strategy, consider this your one-stop guide. And before we go any further, let me introduce myself. My name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into it. Let's start with individual stocks, because this is where many new investors begin. Buying individual stocks means you're investing directly in one single company, a company like Apple or Meta or Amazon. If that company performs well, your investment typically does well as well. If that company performs poorly, your investment might go belly up. The upside here is there's potentially higher returns, but the downside is there's higher risk and a lot more homework. Picking stocks requires quite a bit of research, timing, and a stomach for volatility. Most people find that consistently beating the market with individual stocks is very difficult, especially over the long run. Unless you really enjoy following companies and can dedicate a lot of time, this approach can be risky and very time consuming. Now, a big advantage of using individual stocks is control. You have control over what you invest in and what you don't. You have control over the tax efficiency of the underlying investments themselves, and you can build a customized portfolio based off of your own beliefs about the market and your preferences. You can also do things like using a tax loss harvesting strategy with individual stock picks, which allows you to realize losses and gains strategically to help you not have to pay capital gains taxes or have a current write-down of your taxable income of up to $3,000 per year. These are both examples of how these can help you increase your total return on your investment. Stocks are also cheap to buy and hold. There are no commissions that you have to pay to invest. There's no expense ratios like there are in mutual funds or index funds. And typically there's no charge other than a bid-ask spread, which could be a couple of pennies to thousands of dollars, depending on how frequently the stock is traded itself. The trick to picking good stocks, and this video won't cover some of the strategies like the discounted cash flow model for valuing a company, but there are some key characteristics you can look for in companies that help to make them good stock picks. First is strong financials. Look at revenue, profit, and debt levels. We want revenue and profit to grow, debt levels to remain constant or decreasing, and this will help us to forecast whether this company is making money just in the short run or can sustainably do it into the long run as well. We're also looking for growth potential. How is the company expanding? In a retail setting, are same-store sales increasing year over year? Is the company innovating? Big research and development expenditures that can eventually turn into profit down the line. These are all things that will help show growth potential. Is there a competitive advantage? What makes this company special? Is it like Apple when they introduced the first iPhone, where they had a huge competitive advantage and got to the market first and have really used that as a bellwether to grow their company to the valuation it's at today? Is there some sort of moat that protects it from competitors? These are things that will give you the competitive advantage. The other thing you want to look at is a fair valuation. Is the stock cheap or expensive? A good ratio to look at in order to determine that is the price to earnings ratio. A great long-term strategy is buying good companies at great valuations and holding them for a long period of time. That's how some guy named Warren Buffett, I don't know if you've heard of him, but that's how he got rich. Now let's go over some of the pros and cons of an individual stock investment. The first pro is there's higher potential returns. You could outperform the market if you pick the right stock at the right time. You have more control to include investments that you think will do well and exclude investments that you don't think will do quite as well. And there's also no fund fees. Unlike ETFs or mutual funds, you avoid expense ratios and front-end sales loads. Some of the cons of investing in an individual stock portfolio is there's higher risk. If a company crashes and all of your money's in that one investment, your investment's likely to go down as well. It takes a lot of time and research to effectively invest in individual securities. You need to analyze financial statements, earnings reports, and industry trends after locating a company that you believe in just to make sure it's a good investment. Finally, it could lead to emotional investing where it's easy to panic sell or chase hype stocks because the overall market is pumping up the valuation of a stock, similar to what we saw during the meme stock craze during the COVID era. Now, that wraps up what we're talking about when it comes to just stocks. The next investment we're going to talk about today is the mutual fund. And what I want to do is I want to draw you a picture because this will better illustrate all the pros and cons and the ins and outs of this type of investment. All right, so when you think of a mutual fund, I want you to think of a big swimming pool. And inside this swimming pool, there are going to be a ton of different swimmers. And the pool itself represents the mutual fund, and the different swimmers inside of the pool represent different stocks and bonds that go inside of the mutual fund. So in this instance, let's just, we'll name three of these different swimmers or stocks in this instance. So we'll say that this one is Ford, We'll say that this one is AT&T, and then we'll say that this next one is Coca-Cola. So those are the three different investments, or three of the different investments that we have inside of this mutual fund. Now, the fund manager, what he or she will do is they're responsible for how capital is allocated within this type of account. So let's just say, for instance, that they have a bad feeling that Ford company stock is going to go down in value. So what the mutual fund manager might do is they're going to kick that out of the portfolio. So now Ford is no longer in the portfolio, but they might replace it with another stock, and it doesn't have to be in the same family. But we're just going to use General Motors as an example here, and they're going to put General Motors into the portfolio. What this mutual fund manager is trying to do is pick a correlated asset that isn't that much different from Ford, which they're kicking out of the portfolio, because they're looking for sustained performance, or performance within a sector that isn't going to gravitate too differently from the underlying position, the original one, over the long term. So that might be a way that they're managing this fund. Now, there are a couple of drawbacks to this strategy. So first and foremost, when we kicked out Ford, and we're going to go, we're going to put the number one here as the number one drawback. When we kicked out Ford, let's say that Ford was up 20% when we did that. And let's say our investor, our underlying holding in that was $10,000, or the original balance was $10,000, which means it grew to about $12,000. Now, we didn't change the type of investment that we're doing, but we have a $2,000 gain on that position. If the mutual fund manager in this instance got rid of Ford Motor Company from this portfolio, we realized a $2,000 capital gain, which means we're going to have to pay 15% of that as tax, or $300 in additional taxes that we didn't have to pay just for simply holding this investment. That's why it's a big drawback to mutual funds. Mainly because, especially if you hold them in a taxable brokerage account, because you might realize capital gains in a year when you made no transactions other than buy transactions, and because they're going to pass through any gains or losses from that portfolio to you. So I've actually seen it in years where the mutual fund might be down, and I look at 2022 as a good example of this, where mutual funds were down pretty much across the board, 10, 15, 20%, but they distributed capital gains. So not only were you down 20%, you also had to pay taxes on top of being down. So this is a huge inefficient waste of your capital if you're not investing in the right type of accounts with mutual funds. The next thing that we tend to see with mutual funds that might be disadvantageous for an investor is just the fact that they're not traded like stocks. They're traded once at the end of the day. So we'll put that here. And why that might be disadvantageous is think of back to COVID, when the market was going crazy on any given day. It might have started the day up 10%, then finished the day down 15%. But basically, you're subject to the whims of the market during the course of the day. Whereas with stocks or ETFs, you're not subjected to that once per day trading when the market window closes. So mutual funds, they might have started the day at $100 a share, and they went to $120 a share, and then they might have ended $90 down a share. So you lost 10% and you couldn't do anything about it. Whereas by comparison, we'll just write stocks here in blue. Stocks, you might have started at 100, you could have went to 120, and you could have said, hey, that's a pretty good gain, I'm going to sell. And then when it goes down to 90, nothing happens. So we have a little bit better control over the investment than what we did with the mutual fund. And then the third drawback that we have with mutual funds is just the cost. So there's a couple of different ways that we charge for mutual funds. So if you're dealing with a financial advisor who doesn't have a assets under management fee structure, the first cost is commissions, which can range from 5.75% up front, or can be something like 1% when you sell. So think about that for just an example. At the upfront side, if you put in 5.75% upfront on a $100,000 investment, almost $6,000 is being taken off the top as a commission to your advisor there, or just to the mutual fund company if you're buying it yourself. Or the 1% when you sell, let's say, you put $100,000 in, you let it sit there for 30 years, and now it's worth $1 million. Well, the 1% fee when you pull it out on the $1 million is a $10,000 cost at the very end. So those are two of the different types of front end and back end loads. That is what we call them. It could be called upfront commissions or back-end commissions. Sometimes in the industry we call them upfront loads or back-end loads. That could cost you some money that you don't see with a stock investment or an ETF investment or an index fund investment. The other types of costs you want to be aware of are the 12B1 fees. And these are just the fees that go towards marketing the fund, that go towards paying the fund manager for making those decisions, even though they might be capital inefficient. But the 12B1 fees are going to be somewhere in the ballpark. I've seen them as low as, 0.2% all the way to, 1.5% for just investing your money in the mutual fund. So if you think about it, let's say you're at a 1% fee in a mutual fund on a $100,000 initial investment. We know we had to pay that upfront sales load of 5.75% plus another 1%. You would have paid in that first year somewhere in the ballpark of $6,500 to $7,000 in fees just to have your money invested here. If we know the average rate of return in the S&P 500, something like 500 or something like 7, 8, 9%, it's going to take you at least a year to break even. In some instances, depending on the fee that's charged on the underlying mutual fund itself. So we just talked a little bit about mutual funds and we drew out a picture of, how they work, some of their pros, some of their cons, and why they might not be the best investment for you. Typically, when I look at utilizing a mutual fund, I'm going to wrap it into an assets under management fee program for a client so they don't have to pay the big front end commissions or the back end commissions. We're going to look at share classes that have lower 12B1 fees. I also won't put those investments in a taxable brokerage account. I will specifically reserve those for IRAs, whether they're Roth or traditional. That's typically where they make the most sense. I also shy away from equity mutual funds in most instances and will look to utilize mutual funds on the fixed income side, where I do think they provide a little bit better return than what you can get in a passively managed index fund or ETF in the fixed income space. So that's typically how I am looking at utilizing mutual funds for my clients and how you should think about utilizing them too moving forward. Now, before we dive into index funds, I want to make sure to remind you to subscribe and hit that like button. I'd really appreciate it as we continue to grow out the channel. So let's talk a little bit about index funds now. Index funds are a type of mutual fund, but they're passively managed. Instead of having a manager pick stocks, they're simply trying to track a benchmark like the S&P 500 or the Russell 2000 or the FTSE index in the international markets. Because they don't require active management, index funds have very low fees. So that 12B1 fee in a mutual fund that might be somewhere around 0.5% to 0.6% is typically a fraction of that. 0.02 to 0.04% is very common in the index fund space. And studies show, because of the low fee structure, index funds tend to outperform actively managed funds over the long run. There's also no load fees like there are for mutual funds, which can save you thousands of dollars on the initial investment or on the investment when you pull it out at the very end. And with fewer fees eating into your returns, that's more money that you have working harder for you through compound interest. Index funds also offer instant diversification. They're perfect for investors who want to set it and forget it strategy and simply want to follow a combination of different indices like the S&P 500 and the Russell 2000 and some international indices and build a set it and forget it portfolio that they only have to add money to and worry about taking money out of and rebalancing once a year. In years where you see the S&P 500 up 10%, an S&P 500 index fund will probably be up somewhere around 10% as well. There is a little delta based off of the small underlying expense ratio, but unlike mutual funds where the performance can literally be a margin of error of 20 or 30% different, meaning a 10% return in the S&P 500 might be a return somewhere between 7% and 13% in an S&P 500 mutual fund that's actively managed. An index fund should be somewhere right around that same 10% mark. So whatever the S&P 500 does, that's what the S&P 500 index fund is supposed to mimic. That'll be common course for all the different types of benchmarks out there in the index funds that track those respective benchmarks. One thing to note is that, like mutual funds, index funds can only be bought once a day. So you're subject to market gyrations throughout the trading day, but at the end of the day, when the market closes is when all index fund transactions will happen. The buy orders that were placed during the day will be filled and the sell orders that were placed during the day will be filled as well. But that is the only time that you can go and place orders, or that your orders will be executed that you place during the course of the day. So let's just recap index funds now. So some of the pros on the index fund side is low fees. diversification, consistent long-term performance that'll mimic the index you're trying to follow, and it's a great tool for passive investors. Some of the cons is you're never going to beat the market because you're just trying to maintain performance with said market. There's no control at the stock level. They just mimic the index. So you might have stocks in there like Nvidia that are up 1,500% over the past 2 or 3 years, but you also might have stocks in there like Robinhood the past 2 or 3 years that has, basically gone down in value. I know it's a little bit of a bump recently in Robinhood, but that was a good example of a stock that, plummeted for a good portion of time and before it's rebounded, and you're just kind of subject to watching that portion of the portfolio go down. And it's also subject to market volatility. If we go through an area of time like we did with COVID, where, stock market prices are up significantly one day and then down significantly the next day, you're going to be subject to the whims of that market. But as a passive investor, you should be thinking that the times when the market's down significantly are when you should be adding more funds to this type of strategy, because we know over the long run, buying in at a lower multiple and holding that investment for a long period of time is as successful as a strategy as there is out there. ETFs or exchange traded funds are very similar to index funds, but with a few key differences. Most ETFs also track indices like the S&P 500, and they have similar low fee structures. But unlike index funds, ETFs are able to be traded throughout the day, just like an individual stock. The big advantage here is that you have more control with ETFs over index funds because you can trade them throughout the days. This will allow you to harvest losses as they occur for tax purposes, or if you're a trader, take advantage of tactical market strategies because of the higher frequency of allowed trades. Another benefit, ETFs also have no minimum investment. Some index funds will require you to make a capital commitment of $1,000 or $3,000 to just get started. But with ETFs, you can usually invest with as few as a little dollars, thanks to fractional share platforms like Fidelity, Schwab, or the ones that most financial advisors use. So you can build a really diversified portfolio for $600. $600 will buy you a little bit more than one share of SPY, which is the S&P 500 ETF, at a capital commitment that's half or a fifth of what a similar index fund tracking the S&P 500 will make you commit. One of the big disadvantages of ETFs is the bid-ask spread. Let's say one share of XYZ stock is selling for $100 a share. When you look at the quote on the market, there's a bid price of $99.99 and an ask price of $100.01. That 2-cent difference is the bid-ask spread. Now, if you're buying one share of XYZ stock, that 2 cents is not a huge deal. But if you are trading 1,000 shares, it's a $20 cost, or 10,000 shares, it's a $200 cost. So it's just something to be aware of as you trade more shares in an underlying security. The wider that bid-ask spread, the more you're going to pay as well. So typically the less liquid a security is, the larger the bid-ask spread. It is likely small for ETFs like SPY or QQQ, but on individual securities such as Berkshire Hathaway A shares, it can be as high as $1,000 a share because of how infrequently that underlying security is traded. So let's review some of the pros of ETFs at this point. There's low costs, similar to index funds, but with more flexibility. There's diversification, where you can own hundreds or thousands of stocks in one fund, and they trade like individual securities. You can buy or sell anytime during market hours. They're also more tax efficient than mutual funds. Some of the drawbacks of ETFs are you pay that small bid-ask spread, so on bigger lot orders, you could be paying hundreds or thousands of dollars depending on how many shares you're trading at a given time. Some ETFs have low liquidity, making them harder to trade, and leveraged ETFs like 2x or 3x funds can be very, very risky for beginners. So be sure you're buying the right type of unleveraged ETF if your goal is just to track an index. So which one of these 4 types of investment should you choose? Here's a quick breakdown. There's individual stocks which have high potential reward but have high potential risk. And these are best for experienced investors who enjoy doing research and have the time to apply this to their overall portfolio strategy. Mutual funds are professionally managed, but they have higher fees and limited flexibility. Index funds are passive, low cost, and reliable, and they're great for long-term investors. And ETFs are very similar to index funds, but more flexible and accessible for most people. For most investors, especially those that want simplicity or long-term growth, index funds and ETFs are hard to beat. You get broad market exposure, minimal fees, and a strong track record of performance. If you're looking for automation and don't care about real-time trading, go with an index fund. If you want more flexibility or lower entry points, ETFs are likely your best bet. For certain markets like fixed income, mutual funds will do a really good job of allocating your capital appropriately, but make sure you're using them inside of a tax-advantaged account. Finally, if you like doing your own research and building your own portfolios to completely eliminate fee drag on your overall portfolio, individual stocks are going to be the right pick for you. In 2025, the fundamentals of investing remain the same. Diversify, minimize cost, and stay consistent. Whether you're investing for retirement, financial independence, or building wealth for your family, choosing the right fund can make all the difference. If you found this breakdown helpful, be sure to like and subscribe to this video and share it with a friend who might just be getting started themselves. And let me know in the comments, are you team index fund, ETF, or something else entirely? Thanks so much for watching, and I'll see you in the next video.